Hi, I'm Joseph Falbo, Certified Financial Planner, and today we're going to do an actual 15-year look back, and we're going to talk about the global financial crisis and lessons we can learn from it. Now, 15 years ago, which is very shocking to me how long this is, but that's when the markets began to recover from the most severe economic crisis this generation has ever seen since the Great Depression. The global financial crisis resulted in many jobs lost, stock markets values were halved. That's right, they were in half. The index was in half, all right? And the personal and psychological toll was significant for many people. Now, the global financial crisis was the greatest test of investor fortitude for this generation. There were even many well-intentioned investors that sold stocks as the market went down. Now, the way I look at every experience, whether positive or negative, is an opportunity to learn. Right? What can we learn from the situation? So what can we learn from the past so we can make better decisions for our future? So the question I like to ask is, how much gain did you experience since then? Because since the market bottom in March of 2009, the S&P 500 index is up over 800%, about 15.9% per year. Now, obviously, your risk tolerance has to be in line with that, but how much of that gain did you experience? The only way investors didn't participate in all the gains of the recovery was because they sold out when markets went down. In fact, that's what the average investor did. That's what the average investor always does. But we want to be better than average, right? Selling during scary and uncertain times usually is referred to as getting to safety, right? Making yourself feel better. It's an immediate psychological benefit, an emotional benefit at the time. But it often results in a very real financial cost in the long term. So the lesson learned is, next time you feel the need to get to safety, maybe we can reconstrue this or reframe this and say, I'm going to be reducing my future return by getting to safety, right? Because I got to tell you, for doing this for 29 years, no one, and I mean no one, sells, from my experience, gets back in at the bottom. And if maybe you did get lucky once or twice doing that, there's no way you're doing that consistently. I have not seen it, right? The only way to participate in all the gains of the markets is to ride out all the temporary losses that come along the way, come along your financial journey, right? So here is some sage advice from Howard Marks. Now, Howard Marks is a well-respected investor. He's a hedge fund manager. I respect him. I follow him. And he gave a lot of good advice over the years, and he's given some great advice here to help investors capture market gains. He said our performance doesn't come from what we buy or sell. It comes from what we hold. Okay? So the main activity is not buying or selling. It's holding. It's holding, not buying and selling. So when markets are scary, uncertain, and you go out there and you look and the outlook is dire, the natural reaction, of course, is to sell or to want to sell. But the best response and the main activity for long-term investors is to hold. That won't be easy. It never is easy. It never was easy. But that's why you have me, right? Our focus, energy, and efforts are in holding through the inevitable rough periods, the inevitable corrections, the inevitable downturn, the inevitable recessions, depressions, inevitable and occasionally difficult economic periods, so we can participate in the wealth-creating power of the markets that historically inevitably follow. And we do this all according to your plan. I hope this message helps you.